Hey everyone, this is Mike Del Preti, and you're listening to Context, the podcast where I'm talking to industry leaders about what's changing in the world of residential real estate. My guest today is Justin Messer, President and CEO of Prosperity Home Mortgage. Hey, Justin.
Hey, how you doing?
I am great. So thank you for coming all the way to Boulder for this. Really appreciate it. So Justin and I we met virtually over an email when you just kind of responded to one of my research articles looking at mortgage loan officer origination volume and growth over time. And here we are.
Well, there you go. Yeah, you had mentioned our name too many times for me not to reach out and be like, "Hey, let me give you some context around that. Let's talk about it."
Well, the first email you sent me, it was just like, hey, just wanted to introduce myself. I'm at Prosperity. If you want anything, just let me know. And I remember thinking, I'm like, who is this guy? Like, what is this? And it was literally like days later. I was like, oh, that's the company. I should reach out and have a chat with him.
What I like about you though is it's like, "Hey, here's an email," and then you respond to the email, and then you just immediately called me. Like it was just a number, and I'm like, okay, well, this guy's serious. Like, let's see what happens here.
I'm a big fan of just picking up the phone. It's a
Absolutely.
call. Okay, so for those that are not familiar with Prosperity, give us the quick 30-second elevator pitch.
Sure. So Prosperity is wholly owned by Home Services of America, which is owned by Berkshire Hathaway Energy. So Home Services of America, numerous brands throughout the country, probably, at this point, third, fourth largest realtor based upon the measurement in the country. And we are their affiliate lender. So our focus is mortgage. Not only mortgage, but also insurance attachment as well as we, are the primary referral source over there for the massive network of agents. So both the owned stores as well as a large share of the franchise network for Berkshire Hathaway Home Services as well.
Roughly how many agents? And then for you, transaction volume in 2024?
Yeah, so 2024, we were 7.3 billion in mortgage origination. That's something like I should know this, 22,000 or so
Okay.
units, maybe more than that. And then agents that we support, depending on the day, right? Like all
Mhm.
brokerages, but I'd say, we usually say about 40,000.
Okay. So yeah, pretty big in the space. And I always love including Prosperity in my research because, for better or worse, I think you guys are one of the, air quotes incumbents. You've been attached with Berkshire Hathaway for a number of years now, and it's kind of the almost the best in class. And when you think of mortgage attach, right? If you're a real estate brokerage and you're doing transactions and you want to attach mortgage to it, I think what Berkshire is doing with you guys is kind of the best out there, or at least among the best.
Well, thank you for that. I'll start there and I'll say, you know, we're a very unique breed because we were built out of a real estate entity in the Mid Atlantic called Long and Foster, which at the time was the largest privately held brokerage, third largest brokerage overall. When I joined 14 years ago to start building out the mortgage entity, so we built the company, kind of with Wes Foster, with the Long and Foster team to say, what's the best possible mortgage company to support agents? Right? How can we support realtors in the best way possible? How can we build everything, every process, every product, every concept with the idea of the real estate transaction at the center? That's a little unique versus a lot of entities, right? Which kind of retrofit into, meeting the needs of real estate agents. But I think that approach, which has kind of permeated everything that we've done as we shifted to become Prosperity 10 years ago, and then were acquired by Berkshire, thereafter, I think that's why you see the attachments, so high in our space.
That attach rate, it's about 20%.
A little over that
Yeah.
usually, depending on, if the market's really, really tough, we try not to lead with price. So it can shift, 2, 3% depending on the year.
Yeah.
It's been much higher than that. It's been, much closer to 25 before, and it's been as low as like the high 19s.
Hmm.
But yeah, 20%, 21% is a good number for us.
Yeah, okay. And that's the retort I like, when you see all these new tech companies out there like, oh yeah, we're getting into brokerage, we're going to attach mortgage, and our goal is to get to, 20, 25%, say like, cool. Prosperity's been doing that at scale, tens of thousands of units at 20 to 25% attach rate for years now, almost a decade, right? It's not a new playbook. That's been around for a while.
It's been around a long time. I think that, it's definitely a graveyard littered with folks who've tried it, abandoned it, come back to it, and then, tried to say, hey, we're going to do it just a little bit differently this time and it's going to be great. And it very rarely is. I'll just be honest.
Why does attach always top out at like 20, 25%?
Well, because agents are independent, thinkers. So if you think about that, I'll just say, I don't walk into a real estate office and say, hey, just so you know, we're owned by the same company, therefore you need to use me. Instead, I say, that's the reason you shouldn't use me.
Hmm.
You should use me because I'm great at what I do. And so from that standpoint, there are some offices where I can be 40, 50% attachment,
Hmm.
right? And that's fantastic. But the vast majority of folks, hey, they just aren't going to necessarily want to upset the apple cart in the transaction. So they come in pre-approved with somebody else. Hey, they'll move that way. A lot of agents, they don't necessarily want to direct the transaction, which is fine for us. What I want is to identify a need for an agent or a transaction, fulfill that need in a way that hasn't been done before for them, and deliver best in class service so that we're just top of mind. We never expect to be 100% of any agent's transactions. We expect them to shop it around, to figure it out, and to understand who's going to be, I would say the best fit for that individual borrower.
Why not? Why couldn't you be 100%? Couldn't you do a great job and just kind of keep churning through and being the trusted mortgage partner for an agent?
Absolutely, but I'm not always going to be the lowest cost,
Mm.
and I'm not always going to have the optimal product for that borrower. So, I would say one of our core beliefs is again, we don't want people to be pigeonholed into Prosperity because we are affiliated with Home Services of America. We want people to use Prosperity because it's the absolute best fit for them. And again, sometimes that's we like the service, the convenience, something as opposed to the price. So maybe someone will pay an extra $200 to use us, but that's not always the case.
Do consumers come to you direct or do they always come through an agent referral?
The vast majority are agent referrals. I would love to shift that in our business model, but the vast majority are agent referrals that show up. Generally they're referring a couple partners and we take a look at it. Or, we also do offer a lot of kind of second look concepts where, hey, the agent, they come in pre-approved, they're all good, they're happy. The agent just says, hey, make sure you're getting the best deal. Go ahead and take a
Mm.
look. We'll take a look. And again, if we're not going to be the best deal, we'll tell someone absolutely, just give them that second voice to say, to reassure them. It's a huge transaction. It's an emotional transaction. So as much as we want to say, it's just an interesting concept of, in generationally, I'm sure this will shift, but still today, this size of purchase and this side of financing, people not only want one look, a lot of times they want two people to kind of take a look at it, or three with their agent in there as well to say, no, you're doing the right thing. You can afford this. Everything's there. It's not quite the transaction that I think I would have assumed it would already be
Mm.
5, 6 years ago, where someone just says, oh, great, and clicks on a green button and now owes somebody $350,000.
So you came into Boulder. Before this, you were in Tucson, and before that, down in Austin. Why are you spending so much time on the road traveling around? Like you're the president and CEO of this big business. Shouldn't you be back at the HQ kind of in a spreadsheet?
I try to be in my hotel room on a spreadsheet. I'm a whiteboard person, so it kills me to be away from it. In terms of weeks, though, I spend more weeks on the road than I do in the office in HQ. I am an office person, by the way, so I go into the headquarters when I'm there. But our business is hand to hand combat, right? So I'm constantly trying to show agents, show my mortgage consultants, who what we call loan officers, my operations team members, that I'm in it with them, that I'm listening to them. If you think about it, like, with your tech focus, if you were to think about, hey, I have 400 different clients, trying to productize an offering to meet all 400 of those needs is very difficult because prioritization is just a bear of a task. For me, right, I have 400 or 500 mortgage consultants throughout the country, and I have all these real estate brands, all with different needs. So going to see them in person and talk through it and understand it helps me prioritize that. If I were just sitting in Fairfax, Virginia on my whiteboard, it would be really hard for me to ruthlessly prioritize all of those needs if I didn't really understand it in the market. And, I'll just be honest, I've done thousands and thousands of agent one-on-ones over the last 5 years. And, I just think it's very difficult to build a company to serve a customer that you don't understand. And realtors are extraordinarily unique in terms of a customer.
Hmm.
And everyone has an origin story of how they got into the business and what it is and how they treat their business and the strategies around their business. So if you're not figuring out how to strategize with them to grow their business, you're just not going to be the partner for them in terms of that they would naturally select for their sphere business, especially.
So can you succeed in this space and not do that, not be on the road so much? And not talking about you personally or your company, but other players in this space.
I'm not sure. It's been a winning formula for us. So I think there's two ideas, right? So, let's take, for example, a service that's providing leads to agents or to brokerages, right?
Hmm.
So, whether that be Rocket Homes, whether that be Zillow, whomever it happens to be, you're providing something to the agent in terms of a lead, a tangible thing. And will they then use you or attach with you, especially if the client's already attached to you in some way? So, for example, coming from Zillow, if they're already pre-approved with Zillow Home Loans, is an agent going to rock the boat on that transaction? Probably not, candidly, right?
Hmm.
So, from that standpoint, do you need to have this in-depth relationship where someone has the CEO's cell phone number at Zillow Home Loans or at Rocket to be able to solve a problem? Likely not. If your focus, though, is kind of that sphere business, so the business that they're getting from farming neighborhoods or whatever happens to be, then I think you do. And I'll just give you an example that happened when I was in Austin. So I was in Austin and I was sitting and I just finished my meetings for the day. Okay. So I'm sitting down and I'm right in between happy hours in 30 minutes and this. So found this Belgian bar, wandered in, was having a beer, and I got a call
Mm.
and pick it up. And all of a sudden it's this lovely person on the other line. Hey, this is XYZ, right? And I'm, thinking about it. I'm like, oh, okay, I think I remember this person. I think I know who this is. It's an agent, right? And they said, hey, I've got this problem with this appraisal, goes through the whole thing and is going over the process with me. And I'm thinking, okay, I know who to call. I can get this figured out, right? And then the agent says, so yeah, and XYZ lender, not Prosperity, won't budge. And so I said, okay, understood. So like, what do you want me to do about this? She said, well, could you call him? And, XYZ lender is very large. I tangentially know the CEO there, but it would be very weird if I were to call them about a transaction that didn't involve me, which I shouldn't know about, et cetera. But, what I'm trying to say is that's the level of nationwide kind of relationships that we try to have with agents. And, also we built just a non-bureaucratic, 100% flat organization because, speed kills in purchase lending. Like if you
Mm.
can't make a decision
Mhm.
quickly to do something, people have moving trucks, people have issues. So it's really one of those highly important and highly urgent decisions quite frequently that, agents need to be able to call me and fill me in. My loan officers need to be able to call me and fill me in. Everyone in my organization needs to be empowered to make those decisions if I'm not available.
Yeah. It reminds me of a former podcast guest, Greg over at Tomo. He was saying that on every pre-approval letter, he's got his personal cell phone number on there. So when I do research into the space, which happens occasionally, kind of, for whatever reason, every month I look at MLO counts, mortgage loan originator counts, because I think that's an interesting leading indicator to who's growing and investing in the space, and conversely, who might be declining. And so there's some metrics there, right? There's just MLO count, right? The number of human beings you have. It could be then units generated per MLO or revenue per MLO or volume per MLO. When you start thinking about those metrics, which ones do you care about the most?
I mean, to think about it, there's two thought processes at Prosperity around MLOs and origination. One is to serve offices. Okay, so call it 500 offices throughout the country. I need to have enough originators to support the production coming out of those offices.
Mm-hmm.
The second way to look at it is agent count. And I think agent count is, for us, a more mature way to think about things because if I'm just looking at an office and I say, okay, I'm probably only going to get 15 to 20% success out of that, that's a different staffing model than, hey, I have 200 agents in this office. I can probably match personalities of 5 large originators to these 200 agents and at least give them an option, whatever that happens to be, and let them kind of self-select who they're using as opposed to me dictating it. Kind of the other sphere is, like I said, we built this not to be the best affiliate originator in the country. We built it to be the best purchase originator in the country. And after iterating on this now for 14 years, and I mean, we spent 3 years just building it in the background before we even launched, I can confidently say that we are that. So there is absolutely no reason why agents that aren't part of our companies wouldn't benefit by using us. And we see that because a third of our business, our purchase business, comes from outside agents not affiliated with any Home Services of America brand or franchise.
Where do they come from?
Well, they come from self-generation, from loan officers, from
Okay.
relationships with loan officers, or very fluid industry, real estate, right? People trade brands fairly often.
Hmm.
And as such, they kind of leave. And I mean, what I've always tried to build, and I mean, it's a weird analogy, but I've tried to say, like, just because an agent were to leave Home Services doesn't mean that they left us.
Right.
And
Right.
beyond that, we also understand the power in real estate offices of great partners. So if an influential agent leaves the Home Services of America brand and moves to a different brand, like we believe they can become a vocal voice in that office. And not only that, a vocal voice of support for us. So it's like the zombie effect. So I don't like it if a large agent leaves Home Services of America, don't get me wrong. But if they do, at least there's a hope that they can go and be like, well, I use XYZ for mortgage and they're fantastic. And here are the reasons why. And that's kind of the hope that we see and how that business kind of grows over time.
Okay. So when you think back to some of those key metrics and you start thinking about your peers in the space, does anyone in particular stand out?
When you do look at the productivity per loan originator, if you don't take out refi, the one originator that's a little bit better than us is Rocket, by
Hmm.
like $100,000 an originator or something. When you remove refinance out, Prosperity is just kind of leaps and bounds above what that is. And, I don't really have a specific opinion on it. I could just say that it's a different strategy, which is I'm going to have 10 times the originators and do 2.5 times the volume.
Well, there's some companies in the peer set that might say they're tech companies, right? I don't think Prosperity is going to be out there and saying we're a tech forward mortgage business, right? But there's other ones that are. If you look at the productivity for some of those tech forward businesses versus yourself, do you see any differences?
So I think not. And I think where they're tech companies, so to speak, is in their lead acquisitions,
Mm,
right? So I think that where their leads come from are tech originated, where ours are more sphere business directly with agents. I think if you compare the origination process,
yeah.
you would see that we probably are either further along or on decent ground with most of those originators. We've built this, with a tech first approach, thinking that ease of business is going to be the most important thing.
Where is technology actually having an impact in the business?
Well, it's a thing I take a step back from a lot, and it's just like real estate in some degrees. I mean, it's becoming very commoditized, right? So, it's cost. Like we try to say, it's going to drive down cost. It's driven up costs.
Hmm.
It's done the exact opposite. It's made the transaction by and large easier, but then regulation and compliance have made it harder.
Hmm.
So, if you take a step back, par for the course is easy stuff. Really, where we've made advances is around linking bank account information.
Hmm.
So, getting actual, reliable digital bank account information and being able to verify employment, assets, et cetera, very quickly. So, those automated engines are very quick. And also in closing, some streamlined closing. But, all in all, I mean, almost anyone can get a transaction done in, say, 10 days, right?
Yeah.
Depending on appraisal.
If I'm a loan officer, over the past 5 years, am I able today to move faster than I was 5 years ago?
Tough question, depending on the borrower.
Mm.
So if you have a W-2 borrower who walks in and is willing to link all their bank statements, et cetera, you can operate more quickly. But for us, like it's still dependent on the purchase contract. So it might not matter, right? If the purchase contract says 28 days, we're closing in 28 days.
The big thing right now is, oh, you get pre-approved, I don't know, what, within 15 minutes or something like that, right? Everybody's kind of coming up with these claims in smaller and smaller periods of time. Getting down to a 15-minute pre-approval, is that reliant on technology or something else?
100% technology.
Yeah?
But again, that's linking bank accounts. So as long as you go through the application process and you link your bank accounts and you have a direct deposit,
Yeah.
I can figure out where you work relatively close, figure out how much you make, and then take a look at the kind of house you're shopping for. And, Fannie Mae and Freddie Mac, who are the engines behind this, are going to kind of instantly approve you more or less and say, yeah, it looks good, subject to these other things.
Okay. If you're going to start a mortgage company from scratch today, what would it look like?
Oh, wow. It's tough to say. I think there's such power in real estate affiliation / real estate penetration. It's very rewarding. If you're going to be in mortgage, if your only goal is, refinance, that's putting people in a better position and it's great. But over half of our purchase mortgage loans were first time home buyers. So you do feel at least a purpose driven concept here, running a purchase mortgage loan originator. I think I would probably replicate a lot of what we have today. Just the question is, how durable is the lead source? I think that's always what you have to ask.
And right
So
now, your lead source is your sphere.
it's our sphere and our agent sphere.
Yeah. Yeah.
Yeah.
So how durable is that?
Yeah, it's a good question.
I mean, what's eating away at it?
Well, I think it's external lead flow, right? And external lead flow is kind of the name of the game.
And you're talking about Zillow, Redfin,
Yeah. So
Rocket.
take a step back, right? And my opinion always was that the worlds of Zillow and Redfin and everything we're going to go to. Hey, you have I don't know, put your biometric fingerprint in our app, and then the biometric fingerprint then leads to lock boxes throughout the country, and you schedule your showing whenever you want, and walk in, and then you just buy your house there on a kiosk.
Mm-hmm.
In reality, I think what we've seen is the stakes of the transaction. The emotional charging of the transaction, the size of the transaction has dictated that agents still play a very viable and important part in the transaction. So, from afar, what I think I've seen is, those tech entrants kind of step back and say, hey, instead of actually worrying about closing these transactions, instead, I'm just going to find the people who are best at closing these transactions and route leads there.
And do you think that's Sustainable?
You know, it's interesting. It's a matter of if it becomes competitive and agents can choose their lead source,
Mm,
right? So if you think about new entrants, right? So like Zillow is classically known, Realtor classically known, Rocket Homes to some point classically known. But I think very large mortgage servicers are starting to enter the space. And the question is, are they going to require the same percentage of commissions that potentially the portals? And I say that because their customer acquisition costs might be dramatically different because they may already be servicing the loan for a different reason. It cash flows, it's a different asset. So if your acquisition cost is so low, like, do you start to test the market with a little less of a cut of commission? I don't know. Could be an interesting play.
I see. So just to play that out, I mean, the existing servicer, who's an existing servicer? Mr. Cooper?
Mr. Cooper's a great example.
Right. They've got how many?
Like 6 million customers.
6 million customers. So, throwing some predictive analytics at all those customers, figuring out that, oh, I'm a customer, I'm paying a mortgage, I might be interested in moving. So they pick up the phone, call me, send me a letter, whatever, and say, hey, Mike, if you're in the market, we got a really good deal for you. Is that what that looks
Oh,
like?
100%. And they're going to do creatives down to you all the time in your inbox, just like if you get something from Zillow that says, hey, you still interested in 123 Main Street?
Mm,
The same idea is going to come through from the servicers. And, I think what we're trying to sort out is kind of with all these TCPA consumer interaction laws and what those look like. Does the servicer then have an inherent advantage because they have that relationship with folks and they can get them to kind of raise their hand and reach out to them more easily? That, hey, they can interact through a phone call or a text as opposed to these creative emails, which are a little more passive. And, that's a huge amount of potential leads that you would be throwing off of these massive portfolios.
right. Well, they have them already. They're sitting on 6 million. Interesting. All right. We'll have to watch that. What's something about the mortgage space or the real estate industry now that you wish you knew when you were getting into this?
That was so hard.
Right. You,
Uh,
you
it,
didn't even take a beat. That was an immediate.
yeah, yeah. Well, my background was Rocket Mortgage at that point. It was Quicken. So it was primarily refinance driven, but like a really strong corporate culture, an absolutely fabulous place to grow up and work is what I would say. And everyone kind of marched in the same direction for the same goals. All of a sudden, you come over to a real estate entity with what we call distributed retail loan officers. So that means that they're kind of in offices doing their own thing, all extraordinarily like entrepreneur minded individuals,
Hmm.
clashing at both ends, whether it be the agents who the last thing they want you to tell them is what to do, or these loan officers, which is the last thing they want you to tell them is what to do. And I kind of came in and I'm like, this is a lot more than I kind of bargained for. And then you embrace it, jump into it, and you go, this is a really tough problem to solve. And it gets exciting. And the best way to do it, like I said, has just been grinding down hand to hand combat, getting out there and being face to face with as many people as possible.
It sounds like herding cats and also parenting teenagers all together.
But we love them.
Interesting. And I mean, there's no technology. Is there technology that comes in that makes that easier? Or do you just have to be on the road, engaged in, like you said, hand to hand combat?
So I think technology definitely comes into play, like we said, which is, if I had the ability to provide them a critical mass of leads, I think the relationship would be less important.
Sure. So,
Because, well, and just quickly, I mean, if you provide leads but do an average job, you're going to get probably a good percentage of the business back where you gave them the leads.
mhm.
If you do a fantastic job and provide leads, you're going to be the most successful, mortgage company out there. So if someone can do both of those things together, and top of mind is, oh, my Sphere business, I should also give to the person that's working with me on leads. That's the sweet spot in the magic that I think has been really, really difficult to solve for a lot of the larger lead providers that have tried to enter the space.
So for someone like Zillow or Rocket, what do you think is the most important thing they should be focusing on to grow their business?
It's tough to say because it's not compatible with their model, right? So I think the nut has been difficult to crack for a long time in terms of, say direct to consumer or call center loan officers having the ability to support real estate agents across the entire spectrum of their transactions. In addition to that, it's like, for me, I want to be able to serve every single person that walks into that real estate office, right? So that means, hundreds and hundreds of state bond programs and down payment assistance programs and everything you can imagine. Those don't work all that well on the conveyor belt.
Mm-hmm. So what I'm hearing is for you, it's not one size fits all. You got to have a variety of options because every borrower, every situation is different. But for maybe someone like Zillow or Rocket to fit on the conveyor belt, it needs to be kind of the lowest common denominator. You need to figure out the smallest number of options or products you can offer to people so you can just kind of move as fast as you can.
100%. So, if you're going for the highest technology leveraged solution to originate. It's exactly what you said before, which is it's the old push button, get mortgage,
Mm,
upload my W-2s, move on. Everything else that requires a tremendous amount of, handholding, manual work, that's the tough stuff.
yeah. Okay. What's been the biggest challenge you've faced over the past year?
Well, I'll say 2 years, and it's just been margin compression. So, our post-COVID, our industry just kind of collapsed down. We had to get rid of probably half the people that were in the business, and it was very, very difficult. But last year has been, not too difficult, to be honest.
Yeah. Have you had to kind of reorient how you think about business or people's day to day or the overall strategy? Or is it just kind of, no, we're just going to keep grinding on the direction we're going?
Well, I think our biggest focus has been expanding outside of our walls, and also kind of that concept of matchmaking loan officers with agents as opposed to with offices. I think those have been the two biggest pivots for us.
How do you match make loan officers to agents?
Sure. So, we have these regional sales leaders that, let's say they cover 15 offices and they have 11 loan officers. Like, in no world can I pick one loan officer in a office with 200 agents and assume that they're all going to mesh.
Mm,
So
hmm.
it's about taking the other agents and providing them opportunities with different loan officers.
Okay. All right. Now I got it. That makes sense. Well, I'll wrap today with a question I usually start off with, which is how do you typically start your day?
Yeah, well, I've actually started my day the same way for like 18 years now, which is we have a at-risk report. So it's my interest rate risk management report. And I look at that every morning just to see if anything broke overnight,
Yeah.
if anything's out of whack, if we need to really, really address anything in the morning. I'm a capital markets guy by trade, so that's been my day starter.
Okay. Good. What about caffeine strategy afterwards?
Oh yeah, I'm a fake human, so I run I run on Americanos, or I also just drink normal coffee as well.
Amazing. All right. Well, Justin, thank you so much for joining us. I guess any kind of final closing thoughts you want to throw in before we wrap?
No, I'm just excited about what the next couple of years hold. I think we're in a very transitionary period, and there's a lot of battles happening, both in public and behind the scenes. So excited to see how it shakes out.
Yeah, it's going to be fun to watch. All right. Well, Justin, thank you again for joining us. I'm Mike Del Prete. You've been listening to Context. If you want to jump into any more podcasts, my research, or join my mailing list, head over to my website, mikedp.com. We'll catch you next time. Thanks.